In this session, we will continue with our review of Chapter 10 on stockholders' equity. First, we're going to talk about how to account for retained earnings, dividends, and splits. The retained earnings account carries the balance of the business's net income less its net losses and less any declared dividends that have been accumulated over the corporation's lifetime. Retained means held onto. Successful companies grow by reinvesting back into the business the assets they generate through profitable operations. The retained earnings account is not a reservoir of cash paying dividends to the stockholders. In fact, the corporation may have a large balance in retained earnings but not have enough cash to pay a dividend. Cash and retained earnings are two entirely separate accounts with no particular relationship. Retained earnings says nothing about the company's cash balance. A credit balance in retained earnings is normal, indicating that the corporation's lifetime earnings exceed lifetime losses and dividends. A debit balance in retained earnings arises when a corporation's lifetime losses and dividends exceed lifetime earnings. Called a deficit, this amount is subtracted to determine total stockholders' equity. Most dividends are cash dividends. Finance courses discuss how a company decides on its dividend policy. Accounting tells a company if it can pay a dividend. To do so, a company must have both enough retained earnings to declare the dividend and enough cash to pay the dividend. A corporation declares a dividend before paying it, and only the board of directors has the authority to declare a dividend. The corporation has no obligation to pay a dividend until the board declares one, but once declared, the dividend becomes a legal liability of the corporation. There are three relevant dates concerning dividends. The declaration date, which is the date the board of directors announces the dividends. So the declaration of the dividends creates the liability for the corporation. Declaration is recorded by debiting retained earnings and crediting dividends payable, which is a liability account. The second date is the date of record. As part of the declaration, the corporation announces the record date, which follows the declaration date by a few weeks. The stockholders on the record date will receive the dividend. There's no journal entry for the date of record. And then finally, there's the payment date, which is the date that the dividend usually follows the record date by a week or two. Payment is recorded by debiting dividends payable and crediting cash. Both assets and liabilities decrease. The corporation shrinks. By knowing accounting, you can look at a company's comparative year-to-year financial statements and tell a lot about what the company did during the current year. Analyzing the retained earnings account can give you important information. Net income is the only item that increases retained earnings. Net losses decrease retained earnings. Dividends decrease retained earnings, and other adjustments to retained earnings are usually relatively minor and relatively rare. In most cases, you will know the amount of either income or dividends, but not both. And if you know both beginning and ending balances of retained earnings, you can figure out the amounts you don't know by analyzing the retained earnings account. When a company has issued both preferred and common stock, the preferred stockholders receive their dividends first. The common stockholders receive dividends only if the total dividend is large enough to pay the preferred stockholders first. Dividends on preferred stock are stated either as a percent of par value or a dollar amount per share. For example, preferred stock may be 6% preferred, which means that owners of the preferred stock receive an annual dividend equal to 6% of the stock's par value. If par value is $100 per share, preferred stockholders receive an annual cash dividend of $6 per share, or 6% of $100. Alternatively, the preferred stock may be $3 preferred, which means that preferred stockholders receive an annual dividend of $3 per share regardless of the stock's par value. The dividend rate on no par preferred stock is stated in a dollar amount per share. The balance sheet classification of preferred stock as well as the allocation of dividends may be complex if the preferred stock is cumulative. Corporations sometimes fail to pay a dividend to preferred stockholders. This is called passing the dividend, and the past dividends are said to be in arrears. The owners of cumulative preferred stock must receive all dividends in arrears plus the current year's dividend before any dividends go to the common shareholders. In this sense, cumulative dividends almost take on the flavor of accrued interest on long-term debt, but not quite. Although cumulative dividends must be paid before other dividends, they must still be declared by the company's board of directors. In contrast, interest on long-term debt doesn't have to go through a formal approval process by the board. Nevertheless, the similarity of cumulative dividends on preferred stock with interest on long-term debt are one feature that justify classifying such instruments as debt rather than equity financing. In most states, preferred stock is cumulative unless it is specifically labeled as non-cumulative. So let's walk through an example using exercise 10-28A. Superb Manufacturing reported the following. Preferred stock cumulative, $1 par, 6%, 90,000 shares issued. Common stock, 30 cents per share, 130,000 shares issued. Superb Manufacturing has paid all preferred dividends through 2009. Compute the total amounts of dividends to both preferred and common for 2012 and 2013 if dividends are $90,000 in 2012 and $270,000 in 2013. And here we can see the computation of that. A stock dividend is a proportional distribution by a corporation of its own stock to its stockholders. Stock dividends decrease the stock account and decrease retained earnings. Total equity is unchanged and no asset or liability is affected. The corporation distributes stock dividends to stockholders in proportion to the number of shares they already own. In distributing a stock dividend, a corporation gives up no assets. So why would a corporation issue stock dividends? They could issue them to continue dividends but conserve cash. A company may need to conserve cash and yet wish to continue dividends in some form, so the corporation may distribute a stock dividend. Stockholders pay no income tax on stock dividends. They could also issue them to reduce the per-share market price of the stock. Distribution of a stock dividend usually causes the stock market price to fall because of the increased number of outstanding shares that result from it. The objective is to make the stock less expensive and therefore attractive to more investors. GAAP, or generally accepted accounting principles, label a stock dividend of 25% or less as small and suggest that the dividend be recorded at the market value of the shares distributed. GAAP identifies stock dividends above 25% as large and permits large stock dividends to be recorded at par. And so a stock split is an increase in the number of shares of stock authorized, issued, and outstanding, coupled with a proportionate reduction in the stock's par value. For example, if the company splits its stock 2-for-1, the number of shares is doubled and each share's par value is halved. A stock split, like a large dividend, decreases the market price of the stock, with the intention of making the stock more attractive in the market. Most leading companies in the United States have split their stock. No journal entry is prepared for a stock split. All account balances are the same after the stock split as before. Total equity doesn't change, nor do the assets and liabilities. This table summarizes the transactions covered in this chapter and their impact on the balance sheet. So our next objective is to use stock values in decision making. The business community measures stock value in various ways, depending on the purpose of the measurement. These values include market value, redemption value, liquidation value, and book value. The stock's market value or market price is the price a person can buy or sell one share of stock. Market value varies with the corporation's net income, financial position, future prospects, and general economic conditions. In almost all cases, stockholders are more concerned about the market value of a stock than any other value. Preferred stock that requires the company to redeem the stock at a set price is called redeemable preferred stock. The company is obligated to redeem or to pay to retire the preferred stock. Therefore, redeemable preferred stock is really not stockholders' equity. Instead, it's a liability. The price the corporation agrees to pay for the stock, set when the stock is issued, is called the redemption value. The liquidation value is the amount that a company must pay a preferred stockholder in the event the company liquidates or sells out and goes out of business. And finally, the book value per share of common stock is the amount of owner's equity on the company's books for each share of its stock. If the company has only one common stock outstanding, its book value is computed by dividing total equity by the number of shares of common outstanding. Recall that outstanding stock is issued stock minus treasury stock. If the company has both preferred and common outstanding, the preferred stockholders have the first claim to owner's equity. Preferred stock often has a specified redemption value. The preferred equity as its redemption value plus any cumulative preferred dividends in arrear. And so to compare profitabilities of companies of different sizes, investors use some standard profitability measures, including return on asset and return on equity. This DuPont analysis provides a convenient and meaningful way to analyze the various elements of profitability as shown in this diagram. The left-hand side of the diagram shows that rate of return on assets or return on assets, ROA, is the product of two drivers, net profit and asset turnover. Net profit measures how effectively the company has earned revenue while controlling costs. Asset turnover measures how effectively the company has managed its assets. The leverage ratio or equity multiplier that shows the impact of the use of debt or leverage to magnify ROA. Together, these three ratios combine to measure rate of return on common stockholders' equity or return on equity, ROE, in the last column on the right-hand side of the diagram. And so ROE shows the relationship between net income and common stockholders' equity. ROE is computed only on common stock because the return to preferred stockholders is usually limited to a specified dividend. The numerator of ROE is net income minus preferred dividends, if any. The denominator is average common stockholders' equity minus total stockholders' equity minus preferred equity, if any. So let's say that again. The numerator of ROE is net income minus preferred dividends, if any. The denominator is average common stockholders' equity, which is total stockholders' equity minus preferred stock equity, if any. Most companies do not have preferred stock. Adjustments for preferred dividends and preferred equity are usually not necessary. So finally, let's talk about how to report equity transactions in the financial statements. Many of the transactions covered in this chapter are reported on the income statement, are reported on the statement of cash flows. Equity transactions are financing activities because the company is dealing with its owners. Financing transactions that affect both cash and equity fall into three main categories: the issuance of stock, treasury stock, and dividends. And we see how each of those transactions are shown in the financing activity section on the statement of cash flows. So in this slide, a real-world format for the stockholders' equity section of a balance sheet is shown. All amounts are assumed. In general, common stock comes first. Preferred stock comes first and is usually reported as a single amount. It lists the required dividend, par value per share, number of shares authorized, and the number of shares issued. Common stock comes next and it lists the par value per share, the number of shares authorized, and the number of shares issued. Next is the additional paid-in capital account, which combines paid-in capital in excess of par plus paid-in capital from treasury stock transactions plus paid-in capital from retirement of preferred stock. Additional paid-in capital belongs to the common stockholders. Retained earnings comes from the paid-in capital accounts, and then finally treasury stock comes last as a subtraction in arriving at total stockholders' equity. And so this completes Chapter 10. Please go back and reread Chapter 10 and refresh your memory on the notes, and you may want to listen to the first presentation again and then attempt to do your best with the learning exercise. And so thanks very much, and I look forward to speaking with you again regarding Chapter 11.